Hello, guys. Amazing. I'm very happy to be here with Santiago and with Eddie. Today, we're going to talk about a different company, which is off the radar by other companies. It's called John Menzies, and is a sort of value play. And the reason why we are moving towards small micro cap, this is small micro cap is, less than $200 million pound. The company is English, and is a company which is on the London Stock Exchange. And the reason why we're moving towards that is that we are feeling the market is a bit stretched. We are feeling that all these high growth small cap names will eventually have a correction, and the correction can be 15–20%. We do want to be a bit on the side, and we do think that there is still stocks that can be played by playing the recovery. By be playing the old economy, the ones that was basically under pressure due to the COVID. And John Menzies is a company which is in the aviation industry, and it sounds like it can be, it can be the right one. Let me tell you a bit more about John Menzies. John Menzies is one of is only one of the only 5 or 6 companies around the world that is about aviation, ground. They do ground handlings. They do. They work with cargo. They work with fuel. This industry is very fragmented. So a lot of we're gonna see. Further up that there is a lot of acquisition and weight, and a lot of companies try to put small companies under one big umbrella. Private equity and merger acquisition is private equity company try to acquire company, put them together, and then sell them for a higher multiple. The company, it's John Menzies, has been founded in long time ago, and it's been there for a while. And obviously, as you can imagine, a company that works in aviation is actually it's been hit strongly by the COVID, because of what happened to the aviation economy during this period. Let me just go again with the slide. So those are the services: fuel services, ground services, air cargo. They also VIP lounges and anything that can be connected to aviation. Let's move on to look at what happened to the share price. Let's go back in. Yes. So here we're gonna see that stock price is always been around 500 to 600 pounds, and then he had dropped to about 600 pence. Yeah. So this is expressed in expressed in pence. So the 500, 600 means 5 or 6 pounds. It went down to 0.70, and then after the vaccine news, we bought part of the stock, around 120 pence. And then we are now looking to increase our position because we're really bullish on this. Now with the current price around 230 to 240. Now, just to say something more before we deep into the investment idea, this company was, was a company that was going to be sold probably to one of the private equity fund that has another company in aviation under his umbrella. And we saw a lot of inside buying in 2019 before the COVID. We saw also director buying shares, I think buying up to £5 million in shares. So everything was ready the company was ready to be sold. We have other reports that we're going to mention in description links that were telling us about, were expressing bullishness or based on the potential acquisition target for Menzies. The reason why is that this fragmented industry, tends to consolidate because margins are very low, and consolidations of the small companies are the only way to grow and to gain economy of scale. So let's go now dig into what kind of valuation we're going to do. We did 3 types of assessment. I mean, we did a value investing assessment. We valued the asset value. We did the earning power value, and we checked the difference between the two. And we checked, what is the value of the company under sustainable earnings compared to the value that is now. And we looked at there is a big margin of safety. Then we did also a discount cash flow model, and the discount cash flow model, we assumed we don't have a guidance for the company, but we assumed some very realistic EBITDA multiples. And then we of course did also sensitivity analysis. Then we will explain what this is that in relation to the discount cash flow model we did. And then we looked at merger acquisition, the one I was mentioning before, and at the potential multiples for acquisition, and on the EBITDA. EBITDA is the multiple that is being used, mostly is being used in the aviation for those kind of deals. So a company get bought and sold. Also the same Menzies been buying companies, been buying two companies in the last 2-3 years, and they always been bought on multiple EBITDA. Usually it's between 8 and 12 multiples. Now let's move on, and we're going to explain a bit about the value investing process. So value investing process, there's different way of value investing. Value investing can be interpreted in different ways. There's a different approach. Okay. Usually, what we do, we check the asset value of the company by looking at the balance sheets. We review and adjust all the asset in the balance sheets. Means we look at what the assets are being reported under GAAP accounting and try to adjust to the real value of what should be worth, and so redo the asset valuation in this sense. We do then calculate the earnings sustainable. It means that that means trying to understand what the company can make, not in a good year, not in a very bad year, but smooth it out during a period of 5 to 7 years. We obviously, in order to do that, need to subtract whatever money the company get to spend into growth, because growth is not contemplated. Okay, at least it's not in these cases. And then we also adjust for depreciation in case there is an over or under depreciation. We then understand what is the yield that the company can produce in relation to the asset value. Okay, in other cases, which is not the cases, we also analyze the franchisee value. We only do that when we understand that earning power value is so big compared to asset value that there is obviously a moat, there's high barrier to entry. If there is a high barrier to entry, means that the company can develop, can have earnings which are higher than the WACC, and can compound basically is growth. And in that case, obviously, we will assess also a franchisee value that we'll be willing to pay for that company. When companies don't have a low barrier to entry, when they have low barrier to entry, and they don't have a moat, what happens? They usually all the money spent in growth will be getting back to the WACC, the weighted average cost of capital, and basically the money spent in growth get destroyed. So we're not interested in pay for growth company which don't have a barrier to entry. Okay, but in this case it's much easier because we're only looking at the fair value on the earning power value that we get. So the possibility of the relation between asset value and enterprise value is seen in this slide, and the asset value can be sometimes higher than earning power value. Means you have the asset are more valuable than whatever you produce from those assets. In this case, means the industry in decline, or maybe is an industry which is losing steam. Eventually, what happening is that maybe the management is not doing a good job with trying to retain from those assets higher return. So this is one case. The second case, which is the most common case, is the case in which there is a competitive industry, is the normal management, and efficient management, and what you can get from the asset value is the earning power value that you're supposed to be getting. So it means that you're actually making the money that you're supposed to be making from the asset. So the earning power value is the yield that you get from those assets, and is aligned with the market when the two are equivalent. And there's another case when obviously you have the earning power value which is much higher than the asset value, and in this case means that obviously the management is superior or is able to squeeze, let's use this word, from the asset much higher return than normally any other company will do it. That means that there's superior management, or obviously there's a moat, so the company has a high barrier to entry, and other company cannot get into the same field, cannot compete with this company. That company is able to capture more clients and increase prices without without affecting growth. So that's all basically the big company, the company with the big moat are all those ones that are in the third situation. And that in that case only is when you actually will be willing, you need to assess what is the franchisee value, how much you're willing to pay more for that franchisee value, because that gonna be obviously means that growth can be compounded. So in that case, the value investor is willing to pay for growth. So it's not true that the value investors is not willing to pay for growth. It's true that the value investor is willing to pay for growth in case that there is a barrier to entry. So let's move on to the calculation of the asset value. And maybe we can look one by one very fastly. So in a fast way. So maybe we looked at 30 June 2020 balance sheets. We looked at, we have intangible assets. The intangible asset of this company were a bit tricky because there were property and plant, but those property and plant were property and plant that were not actually owned by the company, but they were leased. Okay, so we had to reduce that accordingly to because what we're trying to do with property and plant and equipment. So I'm talking about the 279 million that you see in the balance sheets. What we had to do when we calculate the asset is trying to understand, at the liquidation value, what could be the value of the asset. So if we sell everything, how much you can get from it. Obviously, if you have in place, leases and things, you won't be able just to sell it. So you probably can pass it on, flip it, or eventually you need to just dismiss the contract. So we use the heavy 50% rate for adjusting the value of this property that are 279 million. Also, the intangibles are related to acquisition. Eddie, if you remind me, there's 2 acquisitions that were done by Menzies recently, right? I mean, quite recently. Can you mention those?
Yeah. They recently acquired Royal Airport Services in Pakistan, and they also partnered with Lyft in South Africa, reinforcing its presence in in Africa and the Middle East. So in 2017, they acquired ASIG Holdings for more than 200 million, and they were expecting to actually add that the profit of that company to their core business, but they couldn't because of the COVID-19 situation. They haven't been able to deploy the whole I would say the whole
right.
strategy.
So basically, we're in a situation where we in the balance sheets an asset, an intangible with is related to an acquisition, which cannot be they could not be they couldn't really make use of it because the cash flow related to that acquisition could not materialize due to the COVID. So what we did to calculate to relate it to the earning power value, we simply reduce it, okay, so that it's not taken into account because that there is not any earnings produced by acquisition.
Yeah, so that was 135.5 million on goodwill, just that kind of acquisition that they couldn't keep on and produce some earnings from that. So yeah, we reduced it and we left it by 46.6 million. As a way to
and then we went on the receivables. I mean, we don't know exactly what the receivable come from. We don't have this information, but we know that Flybe was one of the bankrupt, was a client of Menzies and was one of the company which did bankrupt during this winter, and probably, and also some other small company probably could have been bankrupt as well, or maybe not able to pay the receivables that Menzies was due. So just to be on the safe side, we assumed a 40% adjustment, right, on the receivable. So we assume that part of those money will not be able to be recovered. I mean, it's an assumption. more on the safe side. We don't know exactly, you know, we had to make a number. But in this kind of period, I mean, in this kind of black swan, usually that's obvious that, you know, some of the receivables cannot be charged. I mean, because third parties operators on which you have credit with, usually they might go out of business, they might bankrupt, or they might just have financial issue. So then we adjusted that, and so we came up with a number which is I think the total number that we have with is 488 million, right? At the end of all those adjustments, when we also consider abilities. Then we move to the earning power value, and we calculated the revenue. The revenue is it's an average of the last 5 years. This average will not consider the acquisition, because we took it away from the asset value as well. So those revenue might be increasing in the future years. The margin is the average margin is between 2.5 to 3%. We put the 2.44 there, but obviously the margin can be increasing because the acquisition that were done on business which have a higher margin than the average operating margin. So the operating income will be 36 million. What we did, we decided to not put any over appreciation based on the research we did. We did here spend long time to understand which was the growth. You know, they're supposed to have been how much they invested in growth, and that was a bit tricky, because we had to understand how much the company spend in growth, right? So what we did, we looked at the value of the acquisition, how much acquisition can have, you know, can produce that kind of value, can produce the how much revenue can produce that kind of acquisition. What is the operating expense of the acquisition? And we more or less did the calculation where, you know, we got on 50 million. That is an average amount of money that Menzies spent on based on growth. I mean, of the expenses, of the general expenses of the company, 50 million is the one that is spent on growth. We adjusted that by the tax, and we estimated a WACC at 9%. And here, you know, Santiago can probably tell us why we choose, you know, 9%, and maybe go through the. I can leave it to him more. Go through the earning power value and how did we come up also with the other different, the same kind of value at the discount cash flow. Please, Santiago, go ahead on the WACC. Some of our clients don't know exactly what we mean for WACC, so it'd be great if you could explain that.
Yes, hi guys. It's always a pleasure sharing with you. Well, basically, the WACC is the weighted average cost of capital. So basically, it takes into account the cost of all sources of finance for the company. So in this case, what basically WACC is generally calculated as the percentage of debt times the cost of debt plus the percentage of equity times the cost of equity. Cost of equity is normally calculated by using a capital asset pricing model. We have not, to be honest, relied on all this analysis for the simple fact that Menzies is totally decorrelated by current market, so it's difficult to estimate the cost of equity by using a typical capital asset pricing model, which looks at the beta, so at the correlation of the stock with the market. Going back to your statement, this is one of the reasons why we also like having Menzies in our portfolio, because it is totally decorrelated from the market. Yeah. And given current market situation, that's a plus.
I'm sorry, Santiago, to interrupt. I just want to add this for our, you know, the people that listen to us. Some of them don't have this understanding. I would like to explain them better. You know what we mean correlate. Sometimes, I mean, we also talk about beta, right? Beta is how much is an asset correlated to a benchmark. In this case, for example, we can talk about correlation with SP 500, and and what we know, and you know, that company which are you know, in different market, they have different kind of liquidity issue. They have they micro cap, so they not really they don't have coverage. You know, they not you know, if they have a much lower beta after a number of you know, when you have a lower beta, usually you completely decorrelated by the market, right? I mean, the low beta, you know, I think that 0.3, 0.4, right, is a number after that is not being considered more reliable as a correlation, correct? I mean,
even 0.6 indicates a very low correlation to the market. So in the
means
case
that the company does anything that it wants independently by how the market goes, which is a bet on your knowledge on the company, a bet on the value of a particular company in a particular sector. It's a bet on the idiosyncratic risk of that particular company, rather than relying on the liquidity of the market, on the Fed, on the macroeconomics issue that can affect the company independently by the you know, the intrinsic value. Is it correct? So it's more like I like it because it's like you become sort of like a investor, like a small investor. You invest in a small business, and that business can go you know, can go up and down because of the business itself, maybe the sector as well, of course. I mean, but not the full market, not how much printing there is on the Fed. I mean, is that a good view, a good way to view it?
Yeah, put it simply, this is a fundamental bet. So it's a fundamental bet to recovery, and on top of that, there are also other valuation angles which we can talk about later. In particular, the M&A potential of this company, because as you mentioned before, this company was about to be acquired at a far higher price as compared to current share price. So this sooner or later, this is something which might happen, and clearly acquisition would command a premium on current market value. So going back to the valuation, apart from the earning power value, which you explained before, we have also gone through a DCF.
Sorry, just to go back, just to finalize that one, I just want to mention that what we did, we got the NOPAT, and we calculated NOPAT on the WACC. So we got a net earning power value of 698 million. We deduct, you know, we had to add the net debt, which is the difference between the debt and the cash that were available. The cash that were available, you know, Menzies, as you know, were helped by the American government. I think they got a grant at 52, 53 million. They got some grant from Spain as well. So basically, you know, at the time of the last of June, I think, right? This is ready to September. Sorry, you know, they're 224 million. And if we divide that by the number of shares, we have an earning power value of equity of 452 million, which if we report it on the share price, because there's 84.3 million shares, we have a 5.37, which is 537 pence, 5.37 pounds. Okay, which is, you know, much higher than the 200 market cap, which is the time of writing, which is a price of 238. So we're talking about, you know, more than 2 per value. So as you can see, we have a big difference between the market value. We have asset value, which is similar to the earning power value, a bit higher, but that, you know, can depend from the adjustments that we did, and then which is a big margin of safety. You know, recalling Kat Klarman, Margin of Safety book is an amazing book that we suggest anybody to read. But we have a big margin of safety, which means that, you know, if you don't base the view on volatility, but we base it on we base the risk on a concept of permanent loss, then probably we are really safe, right, on this kind of on this company. I mean, also, if I don't think really safe, because I think there is still a big leverage that we need to be taken into account. And eventually, if things turn around to be nasty, you know, this company is still relatively risky. You know, if COVID will come back or anything like that, you know, there can be still a risk. But please, Santiago, I'll leave that to you now. I memean, go ahead with the discount cash flow. Please go in details so that the people can understand exactly what we did. And then please, I'll leave it to you until the end, and I will come back at the end to just say goodbye to our friends.
Yes, I mean, well, basically, this is a simple cash flow model which we stretched until 2030 because this is a very foreseeable industry. I mean, apart from 2020, which was clearly a particular year because of the pandemic. I mean, this is a quite stable industry. So what we're factored in is basically a recovery in EBIT and the EBIT margin for Menzies over the next 10 years. We have factored in basically a depreciation which is above capex because basically they don't need to deploy more assets because, as you explained before, basically they just bought a company and they were unable to reap the benefits of this acquisition. So what we expect going forward is this company to depreciate at a higher extent than capex, which should be just the maintenance capex. On top of that, just to be more conservative, we have plugged in a negative working capital, although basically this is an issue that we guess they will address going forward, and they will basically stabilize the working capital change has to be rather neutral in terms of cash flow. So then, assuming a 10% discount rate, which we came across as we explained before, and the 2% G, we basically calculated an equity value of around 380 million pounds, which corresponds to 447 pence per share, or 4.4 pounds, as you prefer. And our sensitivity analysis, basically, we have relied on a sensitivity analysis to check how our valuation changed by changing discount rate and G. So each investor can place himself or herself where he feels more confident within the table. So basically, yes, here we see that our central value is around 420 pence. And basically in a range between 9 and 11% discount rate and 1.5 and 2% G. I mean, the fair value is between 300 and 560 pence. If we move down, our valuation range corresponds to an implied EV/EBITDA 2021 between 8.5 and 11.3, which is in line with the M&A transaction we have recently seen in the sector. So this is let's say a confirmation that our DCF, I mean, is sustainable. So on top of that, we have to add the potential M&A premium we were talking before, and that's a bit the flavor on the story and why we are bullish and we are confident that over the long run they can deliver substantial value creation. I'll leave you the conclusion.
This is interesting because basically all the three valuation, more or less, and I think we did the last slide on which we compared the three valuation. The first one is just earning power value. The second, which came to be 5.37. Then we did a discount cash flow by considering a 10% other rate, and if I recall, it was a 2 or 3% terminal growth rate. And then we did the sensitivity analysis, more or less was similar to discount cash flow. And we actually checked that if we have that kind of value, I mean the 420, we'll have an EV/EBITDA which is quite quite cheap. 7.8 times 2021 is really cheap. I mean, probably the truth is that we will be able to, I mean, what we did is, the issue, obviously, we've been very conservative on EBITDA, because we had the EBITDA of 2000, before COVID, the guidance for EBITDA, if I recall, Santiago, was 98 million, something like that. So now we reduce it at 78, which is still 30% more than what they did in 2020, which was obviously a crazy year. So I think that's realistic. I mean, if things go better between April and end of the year, they should be able to catch up, at least to do 20, 25, 30% more than they did this year. And that would be 30% less than what's supposed to be the guidance before the COVID. So if we are around 78 million EBITDA, and we calculate the EBITDA based on 10 times, then we are much higher than that, right? Because at that point, the value will be 780 million, correct? From which we need to, of course, adjust it for the cash and the debt. But roughly, 420 is an extremely cheap valuation. Probably the truth will be anything between the 420 and the 5.5, which is the earning power value. Agree with me, Santiago? That probably could be. Also, because let me add something, and let me know if you agree. I mean, if you buy EBITDA 78 million, you buy the EBITDA with the extremely high growth potential, because obviously in 2022, you will have at that point, 95 or 100 million dollar EBITDA. I mean, unless we're not back into the COVID or any other type of virus. I mean, we should be able to produce that kind of EBITDA with this company, correct?
That's correct. That's correct, because as we were mentioning before, there's also an acquisition whose benefits have not yet been deployed. So, I mean, ASIC was just bought, and the company did not have a chance to reap the benefits of the acquisition. So, what you're saying is absolutely correct.
Yeah, in that case, the earning power will be higher, because probably the margin will increase, and the margin will need to be calculated on a higher revenue, correct?
Correct. All metrics will indicate an higher value.
So 420 will be really the lowest price we will be able to sell. I mean, I would probably be selling around 520, but I feel very comfortable to buy this level. I mean, this is a safe investment. What are the risks? We just didn't cover the risk. I mean, the risk is probably people will travel less, probably.
Prolonged, I would say, prolonged pandemic situation. I mean, the major risk for this company was basically the gearing. So this company was highly geared. So the debt was definitely high, and the company the company market cap was off as compared to current market cap just 6 months ago, and that was an issue. So fortunately, they have already addressed the issue, as basically covenants have been renegotiated, and this is not I mean, an issue anymore. So now we should just wait for let's say a recovery in traffic volumes, and then basically the story should go on and create value in itself.
Okay, great, guys. I mean, I think that's enough for now. I really feel that we're gonna we're gonna review the situation as we go along, and thank you very much. We'll catch up on the next talk. Thank you. Bye.